Hello and welcome to today's video, which is called Panic. It's about tariffs. So let's dive into what has changed in spite of the Sky News rumor that had been floated during the day, leading to much jubilation, and this is how it had reversed. This is the 4-hour chart, and we had seen already a little bit of hesitation to close at those highs. Could have been understandable, taking some chips off the table before heading into the announcement and how it's going to be actually turning out, because there had been plenty of actually conflicting signs. So that will be the subject of today's video. I will be diving into effect on equities, US dollar and bonds. So plenty of ground covered. Watch from the beginning till the end. This is the upper knot that I had been already discussing, and we are seeing a little bit of hesitation. However, it was the actual news that sent stocks lower, and as you can see, Asian session provided a little bit of that can bounce. However, the European session clearly did not and failed in this respect. The picture for DAX is equally unappealing. That's what had been running equities higher into the news announcement. The rumor about 3 bands from 10 to 20, different by country, different by industry, and it was way better than what was feared, because there have been conflicting signs about it being targeted, it being Liberation Day. So let's see who and how and from what was actually liberated. In the April 1st article, I had been having the premium prediction that Trump is unlikely to underdeliver. It had come to fruition, not 100%, but maybe 150 to 200%, because those tariffs turned out to be of more than reciprocal nature, and they had definitely not been leaving any stone unturned, and it's been already their formula that had been kind of indicating that it's about rebalancing international trade flows. This objective and the actual formula that I'm showing you in the following slide, this speaks, and this needs to be said clearly, against a hardball negotiating tactic to start with an unreasonable position, softening it through the negotiation process so as to arrive at a compromise that would be more in favor of the party fielding those unrealistic proposals, expectations, demands, than the opposing party would be ready to accept had these demands not been floated in the first place. So, what is, though, the big effect of rebalancing trade flows? Less need for US dollar in international trade, less willingness of US to absorb international trade surpluses, and of course it means that at the expense of the dollar, which is going to be clearly heading lower, and the respite that I had called the one preceding Wednesday for you, that had added 1 full point to the US dollar index, had been cut very short, and we will dive into the US dollar chart further on. So this is a move to protect the US Treasuries market by bringing yields down. This is the reciprocal trade formula, the reciprocal tariff formula that is actually based on more of the actual trade surplus figure. So that is the end that the administration had been having in their mind. And it has, of course, steep impact on open economies heavily reliant on the export sectors, with, of course, quite suppressed, which is not the feat of internal forces, but plain economics, that their domestic demand would be underdeveloped, whereas the export sectors, be it manufacturing, whatever, would have been overdeveloped. And this is falling particularly heavily on Asian countries. It is falling heavily on European Union as well, on Canada and Mexico alike. So these countries that had been running greatest surpluses with the United States are being hit hardest by those tariffs, and that's the way it is, and what it means for US consumers and businesses. Economic slowdown, it can, over a certain period counting more than 4 quarters ahead, it can shave off 1 to 1.5% of economic growth, and it can add a similar amount to inflation data ahead. This is what it means for bonds. Bonds had been appreciating for a while, and unlike what the dollar is doing pre-market, bonds had not been appreciating in such a stellar pace as the dollar had been shedding value. Picture this chart, how quite tame and behaved, unlike equities it looks, and now the MOVE index, the bond market volatility that I had shown you in the preceding video, to which I will be linking, makes greater sense. Bonds had not been panicked, and equities went through a wild whipsaw, running with the rumor and then meeting the harsher reality than would have been otherwise expected. This is the hit to US dollar, falling through 103.50 horizontal support, and for now still above 100. There can be a little bit of a bounce expected during today's session, but it would not change the picture, and where I see the dollar depreciating over the next 12 months. The 4-hour picture of bonds, and I want to say that whenever I talk bonds within this video, I mean 1 to 3 year bond aggregate. That is the instrument that I'm showing you in this chart. So this is not about the 10-year, which is so much closer to 4% right now, or even the 20 or 30 year yield. This is about short-term bonds. So here we see that there is some kind of a rush out of these short-term bonds, and it is a bit dialing back the effects, the detrimental effect the tariff news had been having on the US dollar, because this is the look of euro to dollar currency pair. It is retracing, and it will be probably pacing, not retracing too far to the downside. The direction is clear in euro's favor for now. Japanese yen, no, don't get me started. This is not about yen carry trade unwind. No matter how Nikkei is suffering as well, no matter that Japanese government bond yields had fallen to, say, 0.8%. No, this is not about that 10-year. This is about decreasing appeal of the US dollar following the tariff announcement. And as I say, this is not the start of a negotiating tactic. This has to work for quite some time to force businesses to relocate their production to the United States. Very similar picture, and probably what is worthwhile noting is that in the lull period of USD depreciation, which I had shown you as having reached, say, 104.50, this had not been having too much of an effect in sending the Swiss franc down, which is an important sign in itself. And the Swiss franc is behaving stronger than the euro itself, which is exactly what one would expect in such circumstances. Because forget not, the ordering of countries is China, EU, and only then comes Mexico with Canada, if I don't count Southeast Asia. In terms of trade surplus run with the United States. Let's come back full circle to stocks, and this is the hourly chart, and we can see that the bounce is not getting anywhere, and it actually just tested Monday's reversal area, and twice had been going south from that point, if you draw it horizontally. So who is in control? What kind of a path can we expect going forward? What kind of readjustments and willingness to buy the dip? What kind of a dip? Is it still a dip? Would come during the regular session. That would be the subject of what I would be covering further on Twitter and here on YouTube for you. Thank you for liking this video and subscribing to the channel. My joint page will help you select what's right for you based on what and how you trade. I can't stress enough the importance of having access to full daily analytics together with premium Telegram channels for most instant updates. You know pretty well my trading journey and what this fabulous infographic means, and obligatory disclaimer, and talk soon. Thank you.